Hi, I'm Steve Rothman with Rothman and Company, and this is another one in our series of talks about university startup companies and their investors. Actually, some of the topics would apply to other types of startups too, but that's the main focus is university startups. And today we're going to talk about strategic financing as an option for getting a company started. So let me start out by defining the terms. A strategic financing. It's a financing in which the party that is putting up the money to get a company going has some interest which is not just to make a profit from the equity interest that they're going to get in the company. They have some other interest. Maybe they're going to be a customer, maybe they're going to be a vendor, maybe they're going to use the technology that's developed as a component in a product that they're going to make, or maybe they're going to use it as part of a manufacturing process. But there's something that they want to get out of the relationship other than just putting some money in, owning the company for a little while, and then selling it at a profit. They may get some equity stake in the company, but that's not their main focus in doing the transaction. So let me give you some examples. The startup is developing a software product for chemistry applications that could be useful in designing methods of synthesizing a variety of molecules. And the company that's investing, they want an exclusive right to use of the software in drug development, but they don't want any other rights. So any other application of the software would remain available to the startup or its other customers. That's example one. Another example would be the startup is developing an electronic connector technology that would be usable in a variety of different types of electronics products. And the company that's investing wants exclusive rights to use that type of connector in robotic products. Another example would be the startup is developing a new kind of material, and the company that's investing wants to use the material as a component of solar cells, but the material also has multiple other potential applications. And last example, but there could be lots of others, is the startup is developing an application that would be usable on a smartphone, and the investor is a mobile carrier or a phone manufacturer that thinks that having this application out on the market is going to help them to sell more wireless services or more telephones. And that's their main objective, selling the wireless services or the phones, rather than making a profit from their equity ownership in the startup. So from the perspective of the startup company, why would you want to do a strategic financing as opposed to venture capital financing, angel financing, bootstrapping, government financing, friends and family, whatever else you might want to do? The basic reason that the startups, that the founders prefer this type of financing, or when they do prefer it, is that it will enable them to keep more of the company. So it reduces or eliminates equity dilution. And what goes along with that is that it typically enables them to retain more control. Usually, not always, the strategic financing partner is not really looking for control. And as I said in the definition of what a strategic financing means, they're usually not looking so much for equity stake. They may get some, but they may get a lot less than what you would give up as far as equity in a venture financing. Another reason is that theoretically, at least, it gives you a partner that will provide you with know-how. There's a company that's in a field or a related field to the one that you want to go into. In practice, it may not really work out that way, and it's certainly hard to get any kind of binding commitment to somehow get some assistance from the partner other than their money. But when people think about it, that's one of the potential advantages, I think, that motivates them. And then the other factor I'd mentioned, there are probably others that you could think of, is that it might create a built-in vendor or supplier down the road. This other company that's going to be investing in you now, they might be somebody that you can sell products to down the road, etc. Okay, so let me hit next and hit hard and right away when not to do a strategic financing. First is when there's really only one field of application of the technology, because then the party that's putting in the cash is going to want the whole field, and that's going to leave nothing for the startup to exploit, and it's going to make the transaction pointless from an economic point of view for the startup, unless they can get some recurring revenue as part of the deal, as well as the initial financing and development payments, and even then it's going to greatly limit the startup's potential. So this is a financing option that you look at when you have, this is an overused term, but when you have a true platform technology that can have multiple applications, at least two, but hopefully a whole bunch. And the second reason why you would not do a strategic financing, and this is you wouldn't do any type of transaction if this is the case, but I have to mention it because I see it happen. You don't do it if the other party won't agree to terms that are fair and of value to the startup, right? You have to be ready to walk away, no matter if the other party is a big name entity or waives a large upfront payment in your face. If the structure is one that ultimately isn't going to allow you to build your own company. Getting financing to build a company is different from getting financing to run a lab, and you have to recognize when the terms that are being offered are not going to allow you to build a company, and if that's your objective, you need to walk away. Okay, so what are some of the pros and cons of a strategic financing compared to a venture capital financing? I've sort of already alluded, the pro is that typically you're going to keep more equity as compared to a venture financing. And what goes along with that, in addition to having a larger percentage ownership of the company, you're more likely to be able to keep more control over the venture. The obvious con is that you're going to give up a field or some group of fields. Usually the one putting up the money, they're going to want exclusive rights in whatever their own core field is. And so you have to weigh these things against each other, and it's not obvious that it's always going to be the case that keeping more equity is better, right? I mean, maybe this is a little bit of a simplistic example, but if in one case you're giving up 50% ownership of the company, but you're keeping all potential fields for yourselves, for your company to exploit, and in the other case you're keeping 100% ownership of the company, but you're giving up 90% of the market to an exclusive license to the party that's providing the funding, that's not a good deal. So you have to weigh those two factors. Other pros and cons, typically, as I mentioned, the strategic investor is less likely to expect control, so if that's an issue for you, that may be a pro of a strategic financing. Another pro, but there's two sides to this one too, the strategic investors usually are going to be less likely to press for a quick exit, and sometimes quick exits are premature exits. So venture capital funds, as you know, the way they're structured, they're typically 10-year funds. It means you're supposed to give the money back to their investors within 10 years. That means, as a practical matter, they really want all their money, their investments, they like to see their investments get to an exit within 5 years or so. They've got to show some results to their limited partners so that they can start to raise their next fund, which is the business that they're in. And you may be, you may have been running your company for 4 years and you think doing okay and eventually going to succeed, but it's taken longer than your lead investors have patience for, and they may push for an exit at a price that leaves nothing for you given the preferred stock hurdle ahead of you, or leaves little for you, and you might have wanted to be able to hang around a couple years longer. In that type of situation, your interest may be better aligned with a strategic investor who typically won't have these limited partners breathing down their neck to give them their money back, so they may be willing to stick it out a little longer if the development cycle is going to take longer. So you should think about this especially if you're in a line of business that has a longer development cycle. But like I said, there's two sides to it. The strategic may never want to exit, and this can be a real issue. Someone who is starting a company with a view to turning it, selling the stock, making a profit, they may find that if they're dealing with a behemoth company on the other side, they're in no rush to sell the thing off. They just want to keep it and run it and have it sort of be an adjunct to the rest of their business, and they're fine with that, but in the meantime, you, the founder, don't have any liquidity. So that's something that can sometimes be dealt with through creative legal terms in the deal, but it's a potential area of conflict of interest. So those are some of the pros and the cons to think about, and there may be other particular ones in your situation. Okay, I'd like to just touch on a few mistakes to avoid and tips about how to approach this if you're the founder of the startup and you're looking at getting into a strategic deal. First mistake to avoid is one in which you keep one application of the new technology and the partner who's putting up the money gets everything else. So often the value of a new technology turns out to be something other than what was expected. And if there are 100 conceivable applications, or even some that weren't conceivable at the time that you negotiated the deal, and you're sure that you're going to use the technology for X, and so you negotiate a deal in which you get the rights to X, but then the investor gets everything else, you're very likely to find yourself down the road, if it turns out that the technology is in fact useful for anything that's commercially viable, that it turns out to be not X, but one of the other things, and you've given up the store. So that's the first mistake to avoid. The second tip would be try to build in the possibility of recurring revenue and not only a one-shot payment. A lot of the times the investors, the strategic investors, they're going to look for a structure of a deal in which, we're going to get your lab, we're going to give you all the money you need to operate, etc., to finish development. But they're going to look at a one-shot payment up front, no royalty, no maintenance payments, etc. And even if that partner is paying for all the development, they shouldn't be able to then just sit on whatever it is you have created and do nothing with it and pay no more if it has some potential value to you. So try to build in a structure where there's going to be some recurring revenue to you, and maybe it's going to be situation specific as to whether you can get it and what it would look like, but maybe it's that if they want to maintain the rights, they have to make some payment some number of years down the road, or maybe there's some small royalty, and it's going to be, smaller, reflecting the fact that they're giving you the financing that you need to get going, but small doesn't necessarily mean zero. Third tip, think about if you can build in a way to undo the transaction if it has not worked. For example, if the partner is not using the technology anyway, but it has rights that are going to block you from pursuing some avenues that seem promising to you, they may be far afield from what the financial partner or the financing partner, the strategic partner, was originally planning to do, but they may have gotten those rights and they may be able to block you. You should have a right to buy back their rights at that point. At some kind of a discounted price, and hopefully, maybe not, but you should be able to buy back their rights somehow so that you're not just stumped by them. Maybe you can, if they're not using it anyway, maybe you can pay them a percentage of the cash that they put in. Maybe you can give them some type of an equity payment instead. Obviously, if it's working for them, they're going to want and they have a right to keep exclusive rights in the field that they paid to develop it in. But if they're not using it, it's really not of value to them, and if you can, you'd like to build in up front in the transaction terms some way that at that point you can get the technology or certain fields back for yourself. And then lastly, don't ever give a right of first refusal on sale of the company. They will ask for it, I guarantee it, and they may even jump up and down and say they're not going to do a deal without it, but if they're interested in the technology, they will do a deal without it. And it is an absolute killer for the startup company in terms of ever getting fair value in an exit. Because what happens in the sale process is you want competition, right? You're going to sell your house and there's only one person that could possibly buy it. They're not going to offer you a fair price. And part of the process of selling a company is that the buyer does loads of due diligence. They spend a lot of time, scientist time, lawyer time, financial people time, and you're going to have to tell any potential buyer before you get too far down the road that, by the way, my original investor has a right of first refusal. And so you may do all this due diligence work and decide you want to buy the company and offer a fair or even generous price, and then find out, well, you can't get the company because this other party is going to step in and just top that price, and they have a pre-existing contractual right to buy. So that's a huge turnoff to the other potential buyer. And what it means is you're not going to have probably any other potential buyers. And if you only have one buyer, you are not going to get a fair price. So do not give a right of first refusal. There are some fallbacks, but I don't even like those if you can avoid them. But sometimes you'll see something where you got to give, if you've made a decision that you're going to sell the company, you've got to give 10 days notice to the other party, not the terms, but just the fact that you're going to sell. And you'd want to limit the information you have to give them. You'd want to not tell them who the other potential buyers are. You'd want to not have to tell them the other price. And you'd want to have it be a short time period that they can, if they want, come in with a competing bid. There's nothing wrong with them being able to make a bid. You like competition, right? You just don't like being locked in to one party as a potential buyer. That's all I have to say today about strategic financings for startup companies. It is March 16, 2013. I'm Steve Rothman with Rothman & Company. I hope this has been helpful for you, and good luck in your new venture.